And welcome back once again, options traders. Well, I posted recently about the VIX and how to interpret the VIX, and I've had a few traders saying, well, what's the difference between the VIX options and the VIX futures? I've heard about both of these. Do they really cover the same thing? Why would a trader use one over the other? And it's a really good question, and unfortunately, to really answer all of those questions, it could require several videos. But right now, I just want to show you the basic differences between the options and the futures and why they can be so tricky when you're using options to hedge a portfolio. They're not hedging exactly what you think that they're hedging. And part of the reason is that the options and futures are measuring different things at different points in time. So if even that sounds confusing, wait till we get started. So let's go have a look. As always, please remember to click like if you like the videos, because it would greatly help the channel. It would be very much appreciated. So let's start with the VIX index. And this is what I posted about recently on how to interpret it. Remember that the volatility index is the VIX. It's just an index. It started in 1993, and it is showing a 1 standard deviation of the SPX, or the S&P 500 index. That's what the VIX shows. However, really important, it is the average volatility over the next 30 days. The key word there is next. So if you see a reading of the VIX at, let's say, 20, it's not saying that that's what the VIX was over the past 30 days, or even what it is currently. That's how most people interpret it. They'll say this is the current level of the VIX. And while that's true, really what it's telling you is this is where traders think the volatility will be 30 days forward from here. So even just interpreting the VIX can be a little tricky. So just remember, it's always looking at the volatility over the next 30 days. Now let's jump over to the SPX options. If you are trading an SPX option, it is really a prediction of the SPX, again, the S&P 500 volatility between today and option expiration. It's not just a 30-day window. It's between today and whatever the expiration date happens to be. So let's say if we have an at-the-money April option that expires in whatever, let's say 23 days. The implied volatility of that option is what the market expects from the SPX in 23 days. So even with that, you can already see there's a big difference between the VIX index and the SPX options, even though traders think that they are measuring the same thing. They're highly related. They're both measuring, to some extent, the volatility on the SPX, but they're going about it in very different ways. Now, to really make things confusing, let's go take a look at the VIX futures. So a futures contract is, sometimes people think it's an option. It's not. It's a delivery for the underlying at a certain expiration date. Now, in the case of VIX, because you can't deliver the actual underlying, they are settled in cash. But the VIX futures estimate the volatility on the futures expiration date. That is the key phrase right there. It is not over a 30-day window of time like the VIX index. It is not over a different window of time like it is for VIX options. Instead, think of it as a snapshot of volatility on a specific date. Which date? The date that the futures contract expires. So for example, let's say that a futures contract is trading at 20% and expires in 60 days. The way that you interpret this is that traders expect the VIX index, will be 20% in 60 days. But remember that that's a 30-day forward-looking estimate. So the way that you really want to interpret that is that the futures show the 30-day estimate 60 days from now. I told you it can get really confusing. So for example, let's jump over to the CBOE's website and take a look at some VIX Futures Quotes. Okay, so on to the CBOE's website. We are at the VIX Futures Quotes page. These are various expirations. So you can see that the VIX for April 20th, that is an expiration date, would be the same as the option. They would have the same expiration date. It last traded at 21.9. So what does this mean? It does not mean that traders think it's going to be an average of 21.9% between now and April expiration. It means that on the expiration date, on April 20th, traders feel that it's going to be 21.9%. But remember what this number means. What it's really telling you is that this is what traders believe will be the volatility 30 days forward from there. So if we go out to the May 18th futures contract, traders are predicting it will be 23.9% on this date. But remember that this number is really a prediction 30 days forward. So it's really looking more for June 18th. So hopefully you get the idea. The main point is it can be really super confusing. So now let's jump over to the E-Trade platform and take a look at some VIX quotes here for the options. So hopefully you can now see why traders get so confused. And they might buy an option, let's say a call option, to hedge their portfolio. And they say, well, I think that the volatility is going to spike in the next 30 days. Let me go buy an option. Well, this option is tracking the futures contract. It is not tracking this index. And remember that this index is looking out 30 days forward. So again, yes, you can see why it gets really super confusing, but this is, in a nutshell, if for no other reason, that you get nothing else from this video, is to realize it is terribly difficult to say, I think that the volatility is going to spike, so let me go buy some call options so that they'll go way up in value when the volatility spikes. You have to realize that these expirations out here are tracking the futures contract of the same expiration date. And so if the traders aren't thinking that the volatility is going to be high on this date, it doesn't matter what the VIX does today. This probably isn't going to budge. And in fact, because of mean reversion, if you do get a really big spike, let's say today or in the near future, these options out here will probably fall because traders are saying, yeah, the VIX might be really high now, but we expect it to come crashing down. All right, so if we go to a chart, we've all seen this on the VIX. You can see that, yes, it goes through periods of spikes like this, but look at how quickly it comes crashing down. So if you were, let's say, on this date, and we saw this big spike during the Russian invasion, you might think, oh, these call options that I bought way out here should go up in value. Well, they're probably not, because traders are expecting that it's going to fall back towards the mean. So once again, I'm just trying to show, especially for our new traders, why it is not an easy thing, and that's also why it's not a good idea to dive into this world of VIX to hedge a portfolio. Now finally, while we're here, let's go over to the quote screen. And if we look at our chart here, the blue line is the historic volatility, and the orange is the implied volatility. So think about this. The historic volatility is looking backwards 30 days, but this orange line is looking forward 30 days. So that's why it's also very hard to do a vertical lineup and say whether the current implied volatility is higher than the historic. And that's because these expectations are at different points in time. So hopefully this helps to give you a little bit of understanding the differences between the VIX, the futures, and the options. And more importantly, if you do find this confusing, at least it shows the need for the education. Because if your trading results are not as expected, it may not be because your outlooks are not correct. It might be that you're not understanding how the derivatives are managed. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatozee.com. Also, please join us on the YouTube channel, Options A to Z Facebook Trading Group, and you can find a link in the description below.